Well, I think the underlying question here with inflation is it being driven by, by supply, by negative supply shocks, or is a part of it being driven by just a positive demand impulse in the U.S. economy? And that matters for monetary policy, obviously, because monetary policy really has more of an effect on demand and in particular on more persistent demand. So when we look at this report, that's what we're trying to parse out. And I think when you look at the headline, it's very clear that, above 4% inflation right now is really being driven by energy supply shocks that we're seeing in the Middle East. And when you look at core, certainly I think that there's, some evidence of supply shocks there as well. So we have tariff-related pass-through that's impacting core goods inflation in particular. That, looks like it's starting to fade, however. And now the question is, the AI-related impulse, how much is that impacting, some inflationary pressures spilling over into the CPI, and I think there's some evidence that that's happening as well. But when we kind of look at overall the data for CPI, it suggests to us that we're getting these supply shocks. Hopefully they will fade. There's been a series of supply shocks. And really the question for the Fed is, will that start to edge up inflation expectations? And as of right now, at least the markets, we think, are giving the Fed a lot of credibility in terms of inflation expectations.
So I think a lot of investors, Tiffany, are looking at the headline print of 4.2%, and they're like, oh boy, that's not good. But the core at 2.9%, that's better, although it's still above where the Fed would like to be. How do you think about that differential there? How much of that is, to use a word, transitory? How much is kind of seeping into the real economy?
Yeah, the difference between headline and core inflation, headline includes the more volatile food and energy prices. Energy inflation really is driving the wedge between the two. And we all know, having, filled up our tanks at the gas station, that we've seen gasoline prices in the United States that have really accelerated. And again, that's the direct result of the pressures going on in the Middle East right now. So again, I think historically, when we've seen these types of elevated energy prices, supply shocks, they have been temporary. And it's important to keep in mind that when global energy prices mean revert, and they likely will mean revert at some point, that will be putting downward pressure on headline inflation. So you could see, if you just look at the energy futures curve, for example, and if energy prices were to follow that, you could actually have headline inflation falling below 2% next year as a result of that, kind of mean reversion in energy prices. So I think the Fed, when they're looking at it, just has to keep that in mind.
Is there a consensus on this? I mean, to me, that's a really bold statement, given what people are living. Do you have a lot of company in that call, Tiffany?
Well, again, if we just look historically, energy and commodity prices, when you do have these negative supply shocks, eventually prices mean revert. The supply, that the markets, will, come back to, kind of a more normal balance over time between supply and demand. We could have, risk premium in the Middle East that starts to come down and things like that. Certainly we will, we could see more elevated gasoline prices for a time. But again, inflation is about the change in prices. So even if, global energy prices stay at these levels, inflation in energy prices will come down to zero, right? So that also is something to keep in mind here. So although we have this elevated level of inflation right now, that probably will peak unless you get another ratcheting up of global energy. So again, we think 4.2 here is likely the peak for headline inflation. You will start to see it come down in the months ahead. And if we do get any mean reversion in energy prices, they come down at all, that will actually, put some more downward pressure on headline, could even see it below 2, as I mentioned, next year.
Tiffany, how about the other side of the equation for our Federal Reserve? The labor market here seems pretty darn resilient.
Yeah, so how I would characterize the labor market is in balance. And when I say in balance, the data, the indicators that we look at suggest that the labor markets are not really a source of inflationary pressures. We have seen payrolls, monthly payroll growth accelerate in the first part of this year, which is very good news. But nevertheless, if we look at job openings, for example, the unemployed, it doesn't look like the labor market here, is really the source of inflationary pressures. Wage inflation has really been decelerating. I think there's more uncertainty around the labor market as a result of the AI dynamics. So it doesn't really look concerning.